There is a lot of drama in the stock market right now, especially for dividend investors, value investors who own stocks like I do, stocks like Johnson & Johnson, stocks like Altria and Philip Morris, and stocks like 3M. There's a lot of drama in the market right now. And so just today, for example, both Altria and Philip Morris tanked. And so there's a few reasons for that. I'm going to talk about that later. Also, there was a landmark verdict in Oklahoma on the opioid case with Johnson & Johnson. There was a ruling that the judge determined today that was released. Honestly, J&J was up on the news, but I don't look at the news that favorably. So there's drama there. And then there's also drama with 3M. We know this ongoing trade war with China, it has no end in sight. And so that's putting a lot of pressure on 3M. And also, quite frankly, just the economy in the late stages of this bull market, starting to see a leading indicator with 3M, B2B companies, industrials starting to slow down. And so you're seeing some of that pressure with 3M as well. Anyways, there's a lot of drama with these names and some others. I want to talk about the drama today. I want to talk about it on a micro level, how I look at it with just these companies in particular. But I want to also take a step back. I want to talk about the drama on a macro level as well. A lot of insights today for dividend investors. So let's get started. So Altria and Philip Morris, it looks like they're talking about joining forces again. And they actually used to be one company. They split ways a number of years ago. The reason that they did that is to basically shoulder or fend off legal risk, if you will. And so Philip Morris, the international unit, would have less legal risk. It wouldn't have to deal with the drama in the US. And Altria would have to shoulder all the drama in the US. And so they split many years ago because of legal reasons and just to kind of fend off risk, keep the risk isolated, if you will, to the Altria company. Fast forward all these years, there are a lot of innovations in the space, new things in the space, such as jewel innovations that I don't think these companies ever envisioned 10 years ago or so when they split. And so they're looking at joining forces again. They're probably doing this for a few reasons. One, to cut costs, because there's going to be cost synergies. You only need one finance team now, not two, for example. There's, for example, marketing people. Maybe you could have one team instead of two teams, etc. They're also probably doing this just because they want to bring these innovations like Jewel to market globally. And so being one company is going to be favorable for that. And quite frankly, they're probably joining forces for the very reason that they split forces a number of years ago. And that's again for legal reasons. They're probably thinking, hey, there's so much drama with our companies these days, the politicians, the governments, the heavy-handed media. They're all coming at us in different ways. Maybe if we're one big company, we can make things a little more stable, a little more risk favorable, if you will, for shareholders. And so shareholders don't have to worry as much day to day because we're a bigger company, more diversified, less concentration of geographical risk. And so in general, quite frankly, I'm a fan if they combine forces again. They don't combine, they do combine. I own both of them. Don't really care either way. People ask me, it's funny on my channel, this is getting a little more philosophical here. Don't worry, we're going to stay micro for a while. But people ask me, Ian, what do you think about this? Oh my goodness, there's all this stuff going on. I'll tell you, honestly, when I saw the news, it doesn't really bother me one way or the other. I like both companies. I love both companies. I'm a long-term shareholder of both. They both rewarded me very well. And my yield on cost, by the way, without even reinvesting dividends on Altria is 21% now because they just raised the dividend last week, I think. And so these companies are awesome. They've rewarded me. They're driving a lot of value for shareholders, for long-term investors. And so whether they stay apart, whether they join forces, I'm sure they will do what is in the shareholders' best interest because they have already historically proved that to be the point. And so when I see this kind of noise, this kind of drama or news, do I spend too much time researching it? These days I actually do because I love you all and you guys want to know my thoughts. And so this channel forces me to be a better investor and to spend more time. But my gut reaction is to look at it and be like, okay, that's good enough. Let me go on my run now. Let me go do my 12-mile run. That's more important use of my time. And so I'll talk more about that later, by the way. But that's my gut reaction on this stuff, is just noise. I pick good companies, I hold them forever, I reinvest dividends, I keep buying more, so on and so forth. The day-to-day news does not affect my strategy too much. That being said, I want to cover this stuff because I know it's real time, and I know a lot of newer investors here on the channel especially are very interested in what's going on, and it makes sense. We'll get more to that later. So what's funny is when this whole merger talk was kind of coming about, Philip Morris, it went down, Altria went up. And Altria went up because Philip Morris, combined with Philip Morris has less risk. Philip Morris went down because Altria brings more risk to the pie. It's that US-centric business. Man, it's just got a lot of risk. And I'll tell you, here's an example. Later in the day, the US House panel, they opened a probe into these electronic products that these firms are now offering. And so the House opens the probe later in the day. Whole industry's down. Now Altria's down. Now BTI's down. Now Philip Morris continues to be down. No one likes this news. And so this is just another example of the government kind of getting in their business, doesn't like what they're doing. And so just day by day by day, these are companies that there's a lot of drama and they're under attack, if you will. And so here's another piece of news that came out later in the day. The North Carolina Attorney General sues 8 of these electronic product companies for aggressively targeting children, or at least that's what they are alleging that these firms did. And so another piece of news, I think this one might have came out yesterday or early this morning. India is proposing a ban on these electronic products. Bad news, bad news, bad news. The news just does not get good for these companies. And so what's interesting is it has pushed the prices down, obviously. Share prices down across the board. A lot of drama. Because I've been at this for 20 years, and quite frankly, because my cost basis is favorable. Look, I bought Altria, my first tranche, way back in the high 15s. And so, you know, right now, what's Altria at? 45. And this is after it fell down today. This type of day-to-day noise, I've just gotten so used to it, and I have these built-in gains that the drama is just less meaningful for me. Whereas someone just starting out, this stuff can be more scary because if, for example, someone is just buying at these prices and then it's notching down the next day because of this drama, people start thinking, hey, am I really doing the right thing here or not? And so I am going to talk about that in the video today. But let me just get into some fundamentals really quickly. Altria, it's at 45 and change. It was down almost 4% today. The starting dividend yield right now on this stock is a 7.4%. When I last did the payout ratio calculation, it was around like a 75%, which is pretty good, characteristic of this industry, because look at all these people that hate them. They're just trying to get cash out of the company to the shareholders where it rightfully belongs, because if it sits in the company, it becomes a target. Now, with Altria, what's interesting now is their forward PE for 2019, it's at a 10.8. So people ask me, Ian, are you worried? Are you concerned? There's a lot of drama. Joining forces thing, that could be good or bad. I mean, they're going to do what's right for the shareholders one way or another. So I'm not worried about that at all. Some of this other talk, like Attorney General, House probe, India, this or that, they're going after these electronic products. That kind of noise, hey, it does create some risk. And so it's something that investors should be aware of. This is why I diversify. But let me put that into perspective. The PE ratio right now on this stock is a 10.8. 10.8. The way I look at it, let's just cut earnings in half. Let's say they lose half their business. If they lose half their business in terms of earnings, the PE will go up to the 20 range, and then it's probably priced similarly to a lot of other consumer staples in this market. So what I'm trying to say is this stock is already at bargain basement pricing. It's at a bargain basement valuation. All of the drama, the bad news is priced in my opinion. And so I just bought some more Altria last week. I'm certainly reinvesting my dividends. Am I going to buy more Altria here? Maybe I will, but in general, I do want to diversify away from sin stocks because they're a very big percentage of my portfolio. If you've downloaded my portfolio, you already know that. If you haven't, I'll include a link in the description where you can check out my full 41 stock portfolio. And so let's look at Philip Morris really quickly. It's at $71 and change. It's down almost 8% today, 7.76%. It's got a 6.4% starting yield, and the forward PE is a 13.7. Again, let me compare this with another stock I own, McDonald's. McDonald's PE ratio right now in a forward 2019 basis, it's in that 27 range, 27. By contrast, Altria is at a 10.8. Philip Morris is at a 13.7. And so I just want to make that comparison because it goes to show how, yeah, there's a lot of drama. Yeah, people in the government and certain media groups don't like these things. But look, even if they get hit really hard, they're kind of priced for that already. And the other question I pose is, what if things work out? What if it goes right? What if the cannabis market, for example, does very well for them? What if this electronic market internationally does really well for them? What if they combine forces? It works out really well. I don't think anyone's looking at that right now. They're only looking at what could go wrong. BTI is trading at $34 and change. It's down 5.34% today, and it's got a 7.9% starting yield. So I don't have a forward PE on them. I couldn't pull that data. The analysts in the United States, on Yahoo Finance at least, where I pull that data, don't offer that information. But my understanding is it's a very low forward 2019 PE ratio. And so, again, what am I doing in this sector right now? Personally, I'm holding strong. I like the companies. They've always rewarded me very well. I'm not going anywhere. I'm reinvesting all dividends. I don't want to reinvest my dividends in these companies. I want to take my dividends and put it elsewhere because I already have a huge allocation in them. But I just have to reinvest the dividends because they're such a value right now. So that's what I'm doing. Am I getting scared? Am I getting caught up in the drama? No, honestly, on a day-to-day basis, I usually don't even look at all these headlines, all this news, but I got to do it for the channel because I love you guys and you want my opinion. So that's why I'm doing it. But usually I would just be like, hey, let me do something more productive with my time, which is usually like going on my run, getting my job done, getting actual work done that produces income, researching new companies, etc. I've already done my research on these. I'm comfortable with them. Any kind of news that comes out, look, they've been through it all before. They'll figure it out, in my humble opinion. Yet this industry does carry risk. Don't let me sugarcoat it. It carries risk. This is why I diversify. This is why eventually, when the stocks recover, I will not reinvest dividends. I'll take the dividends, put them elsewhere, because I only want so much allocation to this more risky industry. So let's talk about some more drama. Let's talk about J&J. All right, state of Oklahoma ordered J&J to pay $572 million in a landmark opioid trial. Basically, what they're saying is J&J's marketing was aggressive. They're saying this not only about J&J, they're saying this about other companies. And there's this whole like public nuisance theory. I guess they've created a nuisance for the public in the sense that these drugs have created addiction issues. They've created issues for the police force, for the fire department. They've created issues for the hospital system. Just for caring for people. And what's interesting about this public nuisance theory is apparently it doesn't require proof of fraud. It just requires proof of a public nuisance. And so they're basically going after the opioid marketing. Now, I want to say something here off the bat. My heart goes out to anyone who has an issue with opioids, who has an addiction issue, whether it's with opioids or with something else. Look, my heart goes out to you. I'm not trying to be desensitive to that or insensitive to that. I am literally looking at this from a mathematical standpoint, from a political standpoint, and from an investing standpoint, but I don't want my investing standpoint to overshadow that I am a human being. We are all human beings here. We're a community. And in this community and beyond, we got to care for each other. We got to be nice to each other. We got to look out for human interest. We got to do what's right. And we got to follow our values. So I just want to be very careful what I talk about here because my heart really does go out and I'm not trying to put an irregard for sensitivity on this matter because it is a serious matter. And so the judge ordered this landmark payout. And what happened? J&J, it was actually up today. It was up 1.44%. In terms of the stats, the starting yield is a 2.9% and the forward PE is a 15. And compare that with McDonald's, which is way higher, 27 PE versus 15. And so what I'm trying to say is the risk here with J&J, it's priced in. This thing is like kind of like the sin stocks, priced in risk, lot of drama. Now, what I am actually surprised that the stock was up. Personally, I would think it was down because this is just the state of Oklahoma. Now, let's say there's other states that try to jump on the bandwagon. Everyone tries to go after J&J, get all of J&J's money, take that money, politicians at these states. They can use it to give people pay raises, including themselves. They can use it to fund more programs. I'm not saying it's right or wrong, but hey, that's probably the natural human tendency, is to try to extract money. And so for me, this certainly does create some risk. Now, one thing I want to talk about is J&J. So J&J, it is, I'm just looking here, there it is, 7.2% of my portfolio. J&J is 7.2%. Let's say this whole opioid thing just blows up and it's really bad. Everything's horrible. They lose, stock gets cut in half. In the worst case, my 7.2 goes down to a 3.6. So I could lose potentially 3.6% of my stock portfolio. This is why diversification is important, even though this is my number one position. Even though I actually think everything will work out, it'll be okay. It always tends to work out in the long run. Let's say that's not the case. Let's say that things go really sour. Because I'm diversified, even though it's my number one position at a 7.2% weighting, I believe my real risk on the table is losing about half, which would be about 3.6% of my total portfolio. Can I shoulder a 3.6% loss of capital? Oh yeah, all day, every day. No worries, not worried. And that's why I diversify. And that's because there is this drama. That's because there is this political environment. Unfortunately, and again, I'm not trying to be insensitive to an issue that's out there, but who is to say that J&J is at blame? There are probably other people in the chain that are also to blame. Who is prescribing these medications, for example? I guess the court is alleging that J&J's marketing practices helped people be more comfortable with these products than they otherwise would, maybe stay on them longer than they otherwise would. But my question is, okay, fine, that's what the court's alleging. But what about the doctors that prescribed these medications? What about the hospitals that employ these doctors? Shouldn't all of them be on the hook as well? And so I sometimes think that these systems, I don't know if they're placing the right blame on the right people. I guess that's a different topic for a different day, and I don't want to get political here on this channel. But the one thing I do want to point out, and the reason I'm pointing this out, is this is the way society is going, in my opinion. Society is going more and more towards this path where government's getting involved, big, heavy-handed government getting involved, trying to get money, trying to go after companies. You're seeing it now with the sin stocks. You're seeing it with J&J. You're seeing this type of, you're seeing certain people wanting this because everyone wants to get what's right and fair to them in their mind. And I don't want to say what's right or fair, but if someone thinks they rightfully deserve that money, they're going after J&J. And so I'm just saying that's the way things seem to be going. And so that's why I diversify. That is a legitimate risk, not only with dividend stocks, but with any stock. Any single stock that you buy out there. People could say the same of some of these tech things, like, hey, I use my phone all day and I can't stop looking at it. Is that harmful to my health? Should we be going after them? There's all of these ramifications across society, but that is certainly a risk that when I see this drama, I see this kind of news, it pops up top of mind for me. It just reminds me that, wow, things are different in society now than they were maybe 20 years ago, certainly 50 years ago. There definitely is more of a blame game, and could that put the companies at risk that I invest in? Heck yes. It's something I have to be very, very comfortable with, and I am comfortable with. I'll talk more about this later. But certainly a dynamic in society right now. And again, I'm not trying to say one side is right, one side is wrong. It is what it is. It's just happening. And so the next thing I want to look at is 3M really quick. And then I'm going to get into the cool macro stuff. So 3M, trade war is not going away. It's trading at $155 and change, which is basically a 52-week low. And the starting yield is a 3.7%. Forward PE now, get this, Thug Life down to a 16.5. I love this. I will be buying more 3M in the coming months. I'll keep averaging in. At these levels, 16.5 PE for 3M. Look, they're going to get through this drama, just as J&J and Sin stocks will, in my humble opinion. But trade war right now, it's not going away, and it's putting a lot of pressure on this company. So a lot of drama. And so what are the key points to all of this? So I have a lot of points macro level points I want to talk to you about. First and foremost, this is just a subset of my portfolio. I have other stocks in the portfolio, like McDonald's, for example, that are at all-time highs, that are trading at a PE of 27. And so it's always important to be diversified and to put things into perspective. The perspective right now is, of my whole universe of 41 stocks, there are a few that are facing some drama. They've got some risk. And if they go down, because I'm diversified, I can shoulder that risk. But it's just worth noting, it's not all dividend stocks, it's some of them. Something else that I want to point out, markets go up, markets go down. It's my belief that we're probably at the point where the market's going to start going down for a while. It'll go down, down, down. It'll kind of bottom out, then it'll go up. Unfortunately, it won't be that simple. It'll be more like ups and downs, and it'll be all over the place. But that'll be the general trajectory if you kind of do a weighted average of everything. The question I want to pose to you, and I'm going to show some charts on the screen right now. Would you, if you're a long-term investor like me, dividend investor, would you rather buy when things have already bottomed out and things are going back up? Or would you rather average in all the way down and then all the way back up? Personally, because I'm in this for the long run and it's very difficult to time the bottom of the market, I rather buy all the way down and all the way up because it gives me more time. Usually when the market recovers, it can be really quick. I want to buy all the way down, all the way back up because it gives me more time to buy my favorite stocks, to average in at bargain basement prices. And so you just got to think at home, which of the two charts is more appealing to you? The one where it's all down and then back up? That's more appealing to me. But if that's not the appealing one to you, maybe some investors are better served to sit in cash, wait for the bottom, try to time it, then get in. That's very difficult. That's why I prefer the dollar cost averaging approach. And I have immediate cash flow goals. I'm already partially using our dividend cash flow to pay for some of our bills. And so I need more cash flow coming in. I got to generate more cash flow. I need it now. I need it practically to enhance our life situation right now. And so I got to deploy money. And so that's how I look at it. But everyone's going to pick what works for them. Generally speaking, you know which one I'm a fan of. So this is a really interesting point I want to next bring up. If you do subscribe to the theory that I do, which is kind of buying all the way down and all the way back up, in the first kind of half of that chart, which could span years, it could be 6 years, it could be 10 years for all we know. Get this. It may be that every tranche of shares that you or I purchase for the next 10 years, we are down. We're down the next day after we buy it. And this is what I tell myself. This is actually how I get more comfortable with capital loss, is that, like, look, and this doesn't just apply to dividend investors. This is stock market investors during a bear market, if you will. Every tranche I buy, I'm going to be underwater because the stock market's going down. But would I rather wait for the bottom and then try to time it and maybe miss it? Or would I rather get really good weighted average, when I average everything together, a really great weighted average cost of equity, cost of my stocks? I'd rather do that. And so the point, though, psychologically, it's really hard to be averaging all the way down and to be like, hey, I bought, it's down. Hey, I bought again, it's down. Hey, I bought again, it's down. It's down, it's down, it's down. It's always down. That is psychologically hard. It's easier for me because I have built-in gains. Like I said, I'm in an Altria at $15.99. But first tranche at least. But if I were just starting out again, it's a lot harder because it's like, man, I'm starting out and it's down, down, down. But the key to all of this is to be prepared for what is likely to come and to have a plan, a strategy. And my strategy, at least, is getting the best weighted average cost of equity of stocks as possible in world-class companies that pay increasing streams of dividends over time that I can reinvest when the stocks are low. When the stocks have recovered, I can take all those dividends and I can use them to pay my bills. And so it's the philosophy, it's the strategy, but it's important to realize in the short run, hey, it may be like this. Every time I buy 3M, it might be lower the next day. I'm comfortable with that because I love getting a good bargain. So moving on, another tidbit. I'll get more to this later. I'm going to share a story, an analogy of my 12-mile run today. But what I want to share is, if it were not for this channel, I probably wouldn't even get into all of these details. And sometimes in this kind of market, where stocks are going down, oftentimes it's better, at least from what I've experienced, not to get into too many details in the news on a day-to-day basis. Certainly on the quarterly reports, on the 10Qs, the annual reports, the 10Ks. Yeah, get into the news, fine, get into the numbers. But I'm talking the day-to-day drama, the political stuff, forget about it. Look, I like to get into the stuff because of the channel. But again, a tidbit for those following along at home, if it's getting to you, if it's freaking you out, if it's creating uneasiness, if it's taking away from your work, your life balance, ask yourself the question, should your time be allocated? Ought it to be allocated towards all of this day-to-day news? Or are there better things? Or is there a different strategy completely? I don't have all the answers, but these are the questions I want you to take home so that you can formulate your own strategy. So there's a question here. Am I buying? Am I buying? Yeah, I'm going to be buying more 3M for sure. J&J likely, but I have a few things ahead of it in the queue. Altria, Philip Morris, already discussed it. Maybe I'll buy a little more. We'll see, but mostly just reinvesting dividends because I already have a huge allocation to those guys and I have elsewhere I need to allocate money. And I'm actually going to be buying a 42nd position pretty soon, so we'll talk about that in a forthcoming video. So stay tuned for that. So something else, I'll link to this in the description below, but what's going to happen here, I anticipate increasingly so in the next few years, especially if the stock market does start tapering off, starts headed downhill, which is, like I said, could be a very good opportunity for dividend investors. I'd rather buy my stocks on sale. I'd rather buy them at lower prices than higher prices, that's for sure. Gets me to my goal, financial independence, retire early on dividends, gets me there quicker. But what's going to happen is some of these haters, they're going to come out of the woodwork and they're going to be like, you know what? I told you so. I even see these comments sometimes. Ian, you're talking about 3M back here. It's down lower. I told you so. And so what's funny is the haters, they'll always comment on those types of things, but there's other stocks that I bring up that are way up. And those ones, the same people, they won't comment on. But the reason I'm bringing this up is not just on the internet. It's elsewhere. It's maybe at work or maybe even at home, maybe with your friend who you're talking about stocks with them. You may get some criticism. Hey, I told you so. Stock market is risky. It's down. Be ready for that. This is one of the reasons I created this community. We are 35,000 dividend investors strong, thug life. We're here to support each other. We are dividend investing for everyone. We've got the YouTube channel here on YouTube. I have a Facebook group now. I'll link to it in the description. I'm on social media all over the place. And we just have a good community. We just had a meetup. It was so fantastic. I'll link to the recap in the description below. This was my latest meetup in San Francisco. Huge success. There are 10 of us there, including myself. Really exciting. And just double down on the community. That's something else, that just kind of a general takeaway in a situation of drama, something that can really help. Now, the last one, again, I want to underscore this. Diversify. People here, some of them, they don't believe in diversification, but the reason I diversify is because of this, just unforeseen stuff. And unfortunately, the world we live in, I think there's going to be more unforeseen stuff because it's more of a kind of big government type of world. And at any moment, who would have thought India, they're going to go after these electronic products and say, hey, they're banned. And hey, if you use it, you're going to jail. Who would have thought? That just came out. That's new news. There's so many unforeseen things out there. I can do all the fundamental analysis I want, but some of these things, they just pop up. That's why I diversify in my stock portfolio. All right, so I want to move on to something here. I want to talk about running for a minute because I went running today. I did 12 miles. There are a lot of analogies between running and between stocks. I think it's really important for everyone to hear this. Hang in there. I know I'm kind of jumping around a bit today. This is more vlog style, just trying to talk about current events in the market because I know these events are keeping some of you. It's keeping some of the investors here up at night. And so running. I ran 12 miles. It took about 2 hours. I'm not the fastest runner, but it was hot out too. And so I do my best in the heat that's out there, but I love running. Now, when I start out, it's always so exciting. It's so exciting when I start out. And so the analogy here is when you start out with investing, it's always so exciting. But the key is to keep the excitement there over time. One of the ways I keep the excitement there over time, at least in the stock market, is I always like to be buying up markets, down markets. Just the thrill of buying, of adding more positions to my portfolio. That's enough to kind of keep me excited because every tranche I purchase, my income notches up. And that's something I monitor very closely. My passive income from dividend stocks is that's what I can use to pay my bills. And so as I go, I like to listen to music when I'm running. If I don't listen to music, the whole process is just a lot less exciting. It goes by a lot slower. And so that's one of the reasons that if you haven't subscribed, I highly suggest subscribing to this channel. If you love the community, you love the content, because this is a community here, and it's kind of like the music for the runner. The community here, it keeps us all going, up markets, down markets. It kind of helps us push the noise out, get other people's perspectives, collaborate, learn new things from other people. That's the reason for the community. It's just like what music is to the runner. And so something else I'll tell you, when I'm running sometimes, and I'm talking only when I'm on flat ground, but I'll close my eyes sometimes, not for too long, but for a little bit. I'll try to zone out a bit. I'll really get into my thoughts. I'll start brainstorming. This is actually where I came up with the idea for today's video. And I actually had a different video planned for today, but I went ahead and did this one because it came to me in my running. And so the idea here is same with investing. If you're investing, you get too much into the details, you get too worked up on a day-to-day basis. It's just not sustainable. So you need to find ways, hey, just like running, how do you zone out when you're investing? Well, one way I do it is I don't even look at the stock prices every single day. Certainly I don't look at like my net worth, my portfolio value on very frequent basis. I just can't look at that stuff. The only thing I track on a somewhat regular basis is my dividend income, because that's my passive income, and it's typically always going up and to the right. It's notching up. It's doing well. And so I'll tell you, I push myself hard when I'm running. I go a little bit further each time. And so it's kind of the same with dividend investing. This is something I want to underscore and that I love. This is honestly, if there's one takeaway from this video, this is the takeaway. Yeah, there's a lot of drama out there and this stuff is hard. Running my 12 miles today, that was difficult. It was hard. It was hard in the heat. I'll tell you, at the end, I hated to do it. I didn't want to do it, but I had to start walking a little bit right around mile 11, or else I was literally going to pass out. And so what I'm saying is, to be a dividend investor, why doesn't everyone do this? Why doesn't everyone retire off of passive income? Because this is hard. This is one of the most difficult things you're going to do in your life. Now, it's easier for certain people. If you're single, for example, you don't have an entire family, and you can play geo arbitrage and move to somewhere cheaper, it can be a little quicker, a little simpler. If you're doing a fat fire like myself, where you live in an expensive area, you've got a family, you've got just a kind of like the finer things in life, it can be slow. It could take forever to get to that financial independence, retire early. And so what I'm trying to say though, just like running 12 miles, the reason I do those 12-mile runs is to remind myself of life, because this is life. Running is life. Dividend investing is life. There's nothing worth having that comes easy. Sure, some people at the jackpot, they get lucky, but there's no fast money. There's all these videos out there, penny stocks, fast money, this or that, growth stocks. Look, I commend people who are doing well in that stuff, and I don't want to put down any one way of investing. But I'm telling you, dividend investing, it's slow money. It takes a while. It's hard. It's grueling. It's real hard. And so that said, it's possible. And why would I not want to try for something that is possible? I know it's going to be hard in life in general. And so that's just something to keep in mind. Now, by the home stretch, I can barely make it when I'm running. And what's funny is some of you Bay Area folks, you'll know this, where I was running today was on the Bay Trail. This is along the nice SF Bay on the peninsula, and where I started out in Redwood Shores near Oracle, and I ran all the way past the San Mateo Bridge, so Foster City area, and then back. And what's funny is when you get back at the end, it always takes longer than you think, because it zigzags back. Like I can literally see, wow, there's Oracle. That's where I need to go. Bam, it's right there. But you think, oh, if I could just go straight, I'd be right there. But it's not like that. It's a lot of zigzags, back and forth, all over, going the wrong direction. Bam, finally I'm at Oracle. This is where I had to start walking today. And so the point is that it really is a marathon, or a half marathon, if you will, or a very long race. And it gets hard in some of the later innings. You know, there's unforeseen things. I had to start walking today. It's hard. And so just like running, dividend investing, this stuff is not easy. It's not easy. If it were, and I'll tell you the hardest part about it, it's the mental side of it. And that's with the running too. It's the mental side of it. And so again, you have to mentally prepare yourself for the market collapse. You have to mentally prepare yourself for every time you buy 3M, it's going to be down, down, down for 10 years. I've prepared myself mentally for that. Same with running. It's mental. It's all that mental. And so I had to walk a little at the end. I had to listen to my body. And so it's the same kind of thing. I didn't want to pass out. It's the same thing with investing. Listen to your heart. If something doesn't feel right in your gut, in your heart, it usually is not. Dividend investors, we need to marry the stocks that we're buying. We need to buy them, hold them forever. At least that's my strategy. That's what I do. And how can I marry something if it just doesn't feel right? And so listen to your heart, listen to your body, just like running. Know what's right, know what's wrong in your heart when it comes to dividend stocks. And some of these stocks I'm mentioning, like Altria, if it just gives you anxiety, it may not be the right thing. I'm just sharing my personal journey here on YouTube. This is what's right for me, but it may not be right for anyone else. But what is right, I'll tell you, is the community of it all. I think that's what will always be right for everyone else. So what else? People, boy, when I'm running today, I was telling myself, oh, I don't know if I can do it. I don't know if I can make it. Investing, you'll tell yourself this. I don't think I can do it. Should I just give up? People be telling you, haters be telling you, I don't know, can you do it? It's the same kind of thing. You got to get away from that negative self-talk, the negative haters out there, and just keep going towards the goal. And it may take a little longer. You may reach the goal a little bit different than you thought you would, but that's okay. It may come differently, but you will adapt. You will modify, just like the running. I had to walk a little bit. And so here's one of the things that I love. I love this. The skeptics will say, stockpile cash, don't invest. Investing, you always lose money. It's not possible. The way I look at investing is there's always going to be drama. There's going to be drama like I talked about today. Sometimes it'll be really good. There'll be no drama, but there's always going to be drama popping up. And I always remind myself, what other alternatives do I have? I could put it in cash. I could invest it in growth stocks. I could do this or that. Whenever I take a step back and look at it that way, despite it being difficult, despite it being a hard journey, what other options do I have? And that's kind of what I honestly encourage you to go home and think about today. Think about the dividend strategy. Is it right or wrong for you? But also think, what are the other options? And so, yeah, when I look at it that way, it's like, yeah, I don't care about the noise. I don't care about the haters. I don't care about the drama. I don't care about the skeptics, the bad news, the government doing this or that. All I care about is my goal. And I keep my eye, tunnel vision, laser focused on the goal. Because I know that's my option. That's what I'm doing. It's one of the best, if not the best form of passive income around. Truly passive income. And what are the other options? And so that's that. So everyone, I hope you enjoyed the video today. Before I actually close out today, I'm going to do my kind of closing here, my disclosures and disclaimer. But hang in today, because this last weekend I went to Gilroy Gardens with my family. This is an amusement park in Gilroy that is not owned by Cedar Fair, but it's operated by Cedar Fair. And so I want to share with you my experience, because people ask me, Ian, when I went to Disney Aulani, I included some of that video footage. People really liked it. And so people want to understand, hey, I'm a Cedar Fair shareholder or unit holder. I know a lot of other members in the community are, and people just wonder, what's it like at one of these parks? Because some of us, we don't have the opportunity to go to these parks on a day-to-day basis. What's it like? And so, whereas they don't own Gilroy Gardens, they do operate it. And so I wanted to share that experience with you, because I thought it was a really good experience. And so you'll see some cool video footage from our time at Gilroy Gardens last weekend. So hang in for that. Before I leave today, I want just to ask you to subscribe. Please subscribe to this community. It is the best way you can thank me for the videos that I produce here on YouTube. Your subscriptions mean the world to me. I love you guys. You are awesome. And so before I leave today, in terms of a friendly disclaimer, today's video, it's not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Just sharing my personal journey here on YouTube for fun. By the way, in the description below, I always have further disclosures and disclaimers. Also, in terms of full disclosure, I own the stocks that I mentioned today. I am long Altria, ticker symbol MO, Philip Morris, ticker symbol PM, BTI, ticker symbol BTI, Johnson & Johnson, ticker symbol J&J, 3M, ticker symbol MMM, Cedar Fair, ticker symbol FUN, and McDonald's, ticker symbol MCD. I'm loving it. So I own those ones in my dividend stock portfolio. All right, everyone. Thank you for watching the video today. I will see you in the next video. But again, before you leave, hang in there because I got some cool footage here from Gilroy Gardens for all of you to enjoy. I'll see you in the next dividend investing video.